Gentlemen, where should we begin? Draghi has been sending these signals for weeks and months already. How significant is it that he chose today to write in Handelsblatt?
I think he's trying to convince the German public that they get ready to do this and try to sort of prepare them. And I think January is like the meeting. Inflation expectations are moving lower and lower. Actual inflation expectations are moving lower and lower. So I think they have to deliver something to be credible in terms of having a chance to reach their target.
But the fact that he's come out today, I mean, does it tell you that he sees this deflationary spiral accelerating?
They're never going to admit that because that's going to make a dent into their credibility.
Sure.
But I think that's how their projections are looking, and therefore they have to respond to it. So I think they'll buy sovereign bonds in January, at least.
Jens Sebastien says that he still needs to persuade a reluctant German public. Does he really need to, though, or is this just a matter of foaming the runway and alerting them to the fact that the 747 is coming in regardless?
Well, yeah, Germany matters a lot more in the Eurozone than anybody else does. And if my Schwiegervater, so my father-in-law, sitting somewhere in Bavaria, he's retired, he gets almost zero yield, and he's being told that he has to pay for somebody in Greece. That doesn't go down extremely well. However, he understands the situation, so it takes a few months or a year for people to really understand and accept the reality which is coming.
However, Draghi says in this Handelsblatt op-ed, quote-unquote, there's unanimity in the ECB Council on the subject of needing to alter the size, speed, and composition of our measures, which everybody is interpreting to be quantitative easing. Is that not true?
Yeah, they do agree on a lot of stuff. The last thing they want to do is actually do it. So they're trying to talk their way, and mainly in lower yield, but mostly lower currency. What they're trying to achieve really is a repricing of the currency rather than the yields. Yields are very low in the Eurozone, but they need
negative 5-year yield on the German 5-year today.
Correct, right, which is good stuff. And what's happening is a lot of foreign investors have to get out of the Eurozone and go somewhere else. However, it's very easy to replace the savings by internal savings within the Eurozone. It's not the case if you sit in Italy or Greece. So they need to compensate that lack of demand by sovereign demand coming from the ECB.
So if they're going to start quantitative easing as soon as the meeting on January 2nd, walk us through what that's going to look like exactly.
Well, so they obviously been buying certain private sector assets already, covered bond, asset-backed securities. So really the big asset that they can buy is government securities. Exactly how they put it together, whether they exclude Greece, for example, that's a really tough decision for them. But they will have to buy several hundred billions worth, and that's going to be the signal that they want to send. And then they hope that puts in motion a change in all investor behavior. And we can see that change already starting to happen. Eurozone investors are starting to be more active in U.S. treasuries, other foreign bond markets. That capital outflow from the Eurozone is absolutely key. I wouldn't be surprised if that outflow in 2015 can be in the region 400 to 500 billion euros worth. Very, very large outflow.
So unlike the Fed's quantitative easing, you think actually this might work to fundamentally improve the economy, right? This is not just about printing money, essentially, and juicing asset prices.
Well, I think it's a two-step process, right? So first, we need to get financial markets moving. And I think there's some evidence that that is happening. The euro is going down. You can see how Spanish bond yields are going lower and lower. And then once that effect has matured, then it translates into the economy. How big that effect is going to be is a very, very tough question, but it's starting to move through the system.
Sebastien, is it going to work entirely as planned, let's say, if the liquidity that the ECB presumably pumps into the system with quantitative easing drives Europeans to do more of what you were just talking about, Jens, which is to say buy assets denominated in U.S. dollars, whether they be treasury stocks or something else, and weakening the euro beyond where it already is at $1.20. Not that that's necessarily not part of the plan, but some of that sort of portends some unforeseen consequences, perhaps.
And one of the unforeseen consequences is, imagine if it all really goes really well, which is that you end up by some miracle euro-dollar at parity, and you have a Republican Congress and maybe a Republican president eventually, and they'll be sitting and very, very annoyed relative to the Europeans and the Japanese. What you typically see when people are too aggressive is you see trade barriers pick up. At the same time, the Europeans are relying on global demand. that means the exchange rate matters, but global demand matters a lot more. So if they get a hit on the demand 1 or 2 years down the road because exaggerated, that will be rather unwelcome.
So I remember when Mervyn King was delivering one of his outgoing speeches at the Economic Club of New York here not a couple of years ago. In fact, I think it was 2 years ago, January, in which he warned of currency wars. It sounds like maybe this year is going to be the year of the currency war.
Yeah, we've certainly seen a very big move in the Japanese yen that was triggered by policy change. We're now starting to see it in Europe. I would say so far, the reason why we don't have the most extreme form of currency war is we have the U.S. being okay with a relatively strong dollar, and we still have the Chinese actually allowing their currency to be strong as well. So those are the two major blocks that are still allowing strength. If that was to change, then we would have an all-out war.
But you see only, what, downside potential for the euro now?
So I think in the short term, I think we can actually see the euro weakness accelerate. I think we're heading into the beginning of the year where typically investors are very, very active. I think the fundamentals and the flows are stacking up very, very clearly. We are just in the process of breaking 120 during this interview. I wouldn't be surprised if we trade 118 within a week. I think we can have a big move in the short term.
Why isn't this bearishness, if you will, for the euro? And it's not just... Do you feel as bearish about the euro as the Jens does?
Definitely. Which is slightly frightening.
So
actually.
before the show, I was looking at the forward curve for the euro and do not see this weakness reflected in the forward curve. How come?
So the way the
bearishness, I should say.
Yeah, the way the forward curve is set up in currency markets is directly a function of interest rates. So we happen to have very similar interest rates in the U.S. and Europe. So that's sort of how the forward curve comes about. But it doesn't mean we can't deviate from the forward. So I'm pretty confident that we're going to go low in the short term.
And if you look at Russia, where there was really a currency war and the Russia lost, if you look at the forward market, it really indicates a deep, deep bearishness built into it. You know, tremendous amount of bearish expectations on that economy.
If there were one currency to bet on outside of the U.S. dollar this year, what would it be?
So I think given the move we've had in energy, which is obviously a huge move now, I don't think the Canadian dollar has moved enough. I think fair value, if you plug in current energy prices, around 122, and we're around 117. We were 116 yesterday. So we're heading towards an equilibrium that is perhaps 5% lower than where we are now at least.
Well, this is funny. This is where we're going to get our real disagreement. I've been long-term bear on CAD, but the problem is for Canada is really how bad energy prices fall. If they really fall much worse, we get a credit crisis essentially in Canada, in Alberta. If they don't, what you'll see is they'll also benefit from the fact that the U.S. economy is doing very, very well. So that typically mitigates the negative impact from lower oil prices. So I think we definitely could touch 120, 122 at one point, but I think by the end of the year, probably Canadian dollar will be one of the few currencies actually maybe to manage to outperform the dollar, which is, I think, going to be a rare feat.